In this video, traders, we're going to look at the advantages and disadvantages of scaling into a position. Stay tuned. Hey guys, warm welcome to you. Right, so pros and cons, advantages, disadvantages of scaling into a position. So first of all, why would you ever want to scale into a position? So imagine this chart here, and it could be multiple examples of setups, but I like to do this one because I think that it's an obvious one, and it's one that really works well with scaling in potentially. So when you would scale in, let's look at the pros and cons after. So you'd scale in when you're in a situation where you have a zone of interest that you'd like to buy or sell in. So you'd like to initiate a position in this zone. So that is, some setups obviously aren't that case, but some are a case where, hey, you know, I don't know where in that zone it's going to turn, but my thesis is the market is going to turn at some point in that zone, right? So you kind of say to yourself, I've got a couple of choices here. I can either start to buy at the top of the zone and go all in my position there. I can buy all of my position at the bottom of the zone there, or I can scale the position throughout the zone. Now, let's look at if we went to number one. So I'm going to put a marker on as number one. I'm going to put number three as we were scaling and number two as the bottom. So if you look at position number one, i.e. I'm buying right there. The biggest thing, of course, is potentially the amount of heat you would take on the trade and the stop position, ultimately affecting the risk to reward ratio. In other words, if you're buying here, effectively, if you still think it's a buy right down here, your stop's probably got to be here. So all of a sudden, you perhaps have doubled your stop loss position and you've affected your risk reward accordingly. And again, obviously the heat, you might end up sitting through a trade that's sitting in that level that's still an absolutely fine trade by your thesis. And so that's the downside. The plus side, of course, is that if the market just kisses that and rips off, you've got your position. So you might want to do that if for some reason you don't think the market's going to encroach too far into this zone. And by the way, let's just go back a second. You may well have this zone if you've had multiple tags of a level, but maybe the last level was a bit higher, maybe it was a bit lower, but the actual support line isn't quite so clear. So if we looked at a chart here, perhaps you've kind of got this scenario where you've had multiple tags of a level. You're like, well, there's a bit of support there. I want to buy at that level, but where do I buy it? So that's really what that would be if we extended it out to the left-hand side of the chart. So number one, lots of heat, your risk reward ratio ends up getting skewed, I'm taking a big stop. Number two, which is if we buy it right at the bottom of the zone, let's say down here, number two, obviously the best reason for that is that you are taking much less heat on the trade because your stop's going to be much tighter. Your risk reward ratio then increases, assuming you've got a fixed reward up here somewhere. The risk reward ratio increases dramatically and becomes way better. But the downside is that you might not get filled. You're only going to get filled if it comes right to the bottom of the zone and tags you. So I'm going to put no fill here as the downside. So there's a downside things here. We'll look up sides again separately. So no fill. And so the sweet spot may well be to scale into a position. So in other words, how would you do that? So let's say you're trading £10 a point. Let's say you're spread betting or trading 10 contracts, whatever. I don't need to go into the different things here. I think you get how what we do if we were scaling. You would split your order up and you'd say, right, I'm going to do some here, I'm going to do some here, some here, and some here. So split into 4 or 3 or 2 or whatever. Now, you can obviously have equal amounts. So you could, if it allows it to be that, let's say if you had 8 contracts here, 2, 4, 6, 8, or you could say, right, I want to make sure I'm in, but add to the position if it goes against me. So I might do 4 here. So I might do 4 instead of 2. I might do 4, and I might do 5, and I might do 6, 7. I might do a final one here. So I could split it up like that. Or of course I could reverse stagger it. So I could go, right, well, I'm going to just do 1 here, and I'm going to do 2, and I'm going to do 3, etc. You get the idea. So you can play around with it. So really, it's up to you to decide what's the most important to you. If you want to be in the trade, you want to have a piece of this regardless, then you want to scale. You say, yes, I want to scale. And ultimately you've got to decide how much you want. You probably, if you want a piece of it, you probably want a decent chunk. So you might even go for this middle one and say, well, I want to get half here, but I'm allowed another size, so let's say even 4, another 4 at various levels down to here. The key to this is to work out and plan this trade and say, okay, well, if I do this, where would my average be? My average would be approximately here, because it's going to be the upper end because you're doing the majority of the position near the upside. Fine. Where does that put my stop? Right, well that makes it slightly better than going all in at one, but not so much. I need to give it a little bit more room. Okay, well maybe then you need to use this one where the majority of the position is put on the bottom, but you've still got a little position if it just comes down, kisses and rips off, in which case your position entry average is going to be around here somewhere. The risk reward becomes much better. So the key things to look at, guys, are number one is what's the risk reward ratio of the trade? Well, obviously the first one is where the stop's going to be regardless of where you get filled, because you don't want to fall into the trap of scaling and scaling in, or scaling and scaling and scaling, the whole thing rips through the floor and you end up wiping accounts out. No, this is structured scaling based on a plan. So once you decide, okay, where my stop is, and then you decide where my target is, or approximate target. Admittedly, things can change and price action changes and bits and pieces change and alter your decision. But if you've got that primary target and primary stop, you go, right, well, where really does this work out, this trade? Well, obviously, perfect world, you want to be at the very bottom and it pushing to the upside. But then you have to ask the question, okay, well, if the price does start against the lows, is it still the same trade? Do I actually prefer it to be not so low? Does that mean it's a stronger trade for me? Or am I actually looking for a fake out? Do I want it to go lower? There's often two things you want to see. I know for myself, sometimes I don't really want it to go through that low. That low may well be there, but I'd rather see strength come in before for me to have ultimately what I'm trying to predict the price to do, or what I think the price is going to do after. And very often it's the opposite. It's like, listen, I don't want you to turn now. I want you to go and flush and then come back up so I can frame things a bit. So it depends on what you want to see for the trade you're taking. And then you tick that off the box and go, right. And then you can come up with a strategy around that and go, well, actually, you know what? I need to have the most position as possible at the beginning and then add more as it goes down. Or actually, you know what? I really want to see it kind of wick through, but I'm not sure if it's going to, but I still want to have a bit of size of it. All right, well, I'll just go a couple of units at the beginning and I'll put my bigger batch as we wick through right at those lows, assume it'll pop up. If it doesn't, my stop's reasonably tight on that last batch, but it's reasonably acceptable on the average. So this is really interesting, guys, because you're starting to get a little bit more advanced of how you execute stuff. And it's not always appropriate. You know, very often it's appropriate to go full amount straight away. But sometimes having this extra dimension, extra layer of thought process behind it and planning can really make the difference between, you know, getting on a trade or getting a little bit out of a trade that you would have not made so much on, or, you know, there's various kind of upsides to doing this, which you wouldn't do if you try to get all or nothing and try to pick that sweet spot. All right, guys, let me thoughts on that in the comment section below. Scaling, do you scale already in position, or you're an all in, all out kind of trader, or do you like to kind of dabble in and dabble out of position? How do you use scaling, if at all? And if you like this kind of stuff, of course, a thumbs up is much appreciated from you, as it is always. Take care, keep your risk managed. Bye-bye.